When it comes to day trading, it is very hard to find a good trading strategy that makes sense and also to hold yourself accountable to that trading strategy that you can go step by step higher. That means to the next level. And I'm going to tell you this in this video, everything you need to know. So the first thing is important that it fits with your schedule, because in trading, we don't just make money every day and every week. In trading, you will have different market phases. So it's important to understand what market to trade. What is my trading strategy? So options trading, stock trading, or day trading futures. What is, for example, in my case, makes the most sense. Because when day trading futures, you don't need to have especially over $100,000 or $200,000. You can just start with $1,000, $3,000, $20,000 for later. And this is something what is really, really cool, using also a demo account. It means a not real money account. The other thing what is really cool is that you just need to trade like 1 or 2 hours, and it works like this. You need to make sure that you understand that there are different markets and what of these markets makes more sense. So the S&P 500 futures is one of the best markets because these are the 500 biggest companies of America. And the awesome thing about this is that every 4 months, new companies gets in, old companies are getting out. That means that when you're sitting down on your computer for 1 or 2 hours, very often the market is running for 30 minutes or 5 hours or even longer in one direction. That means just going higher or lower, or it just stays at one price line. So it's way more beneficial to trade that market than, for example, I think like Swiss franc, Euro, US dollar, for example, or even gold, silver, because you'll see very often that the market is just going very fast in one direction, turns around, and this is where we just start losing money. The next thing is about the trading strategy. So we figured out now day trading is very cool because we can just sit down on the computer for 1 or 2 hours, for example. If we do this right with a good market, we will just see like past 2 hours, it was going up. And then we can just assume the next 1 hour is also going up. And very important is that it will not happen every day. It will not happen every week. But I'm telling you, if you trade for 3 weeks or 5 weeks, you will have multiple days where the market is doing that and it's doing it consistent. And if you have a good trading strategy, then it depends now also on the money-making activity. That means like what length is the market doing in average, past hours between like every 10 minutes, every 30 minutes in average, to expect that the market is doing that also in the future and not just to have like just assumptions that doesn't make any sense. So we're looking forward to make assumptions that are realistic. That means like we look at the past 1-2 hours, how much length did the market do? And then we just transfer it into the future. And very important is it shouldn't be like from news or something, like it should just be regularly, right? So once you got that figured out, then it's all about the trading signals and to build a relationship to the market. That means if you just now trade for 1 or 2 hours, for example, between, if you're from the US, 9 a.m. to 4 p.m. If you're from Europe, it would be like 4 p.m. to like 10 p.m. 1 or 2 hours is enough. When you start there, it depends now what kind of chart do you use. If you use something like a 5-minute chart, you will only have 12 candles within an hour. And I think that is not that efficient. If you use like a 15-minute chart, like you only have like, what is that? Like 2-4 candles, like that's already it. But if you use a 1-minute chart, you have 60 candles within 1 hour. And many people are struggling with that because they're too much zoomed in and they can't see 1 or 2 days. And this is something what is really important. You want that when you're in a 1-minute chart to zoom out, that you can see 1, 2, or even sometimes up to 3 full days. And this is even possible with a small computer because platforms that are free to trade in the demo account, that means a not real money account, and to trade, be able to trade also with a real money account without paying any money, like TradingView. Really, really cool. People are paying thousands of dollars to pay for trading platforms, but they cannot trade with the amount they paid for the trading platform with their own account. Like, that doesn't make any sense. But when you use TradingView, for example, there is an option on the top right side that you can zoom out on the program itself. It's like you have a bigger screen, but actually you have a small screen. And also TradingView gives you the opportunity in comparison to other trading platforms that you can zoom out way more when you're in a 1-minute chart, that you almost can't see any candle. So in a 1-minute chart, you could see like the whole day structure and the past 2 or even up to 3 days around. And then you can see those very big structures where the market likes to go at. Because the market is an auction process, the S&P 500 futures goes either to a bigger structure high or goes to a bigger structure low. And if it cannot reach that and it's just too much in the middle, it will aim for smaller structure highs and lows. And if they're too small, then the market is just wiggling around and it's not that worth it to trade. So if you compare always like between like 3 to 5 weeks, you will see that the market is going there in a specific direction. So here's now the thing. Taking a picture in the beginning is something what's very important, and drawing in a square just like front within 1 hour or 2 hours, depends on how long you want to trade it. And then taking a picture after 1 or 2 hours to see where the market was really going at. You especially want to take notes in the beginning, like what do I see what the market did the past 1 or 2 hours? I'm taking a picture of it, and so I can see like 1 or 2 or 3 days. It's really not about the past 10, 20 or like 30 candles in the 1 minute chart. It's more about the 1, 2 or 3 days, comparing them, looking forward on the next 1 hour. What does it make sense that the market will do, especially using the S&P 500 to its personality. And when seeing like that the market is just on one price line, assuming that the market stays there, but seeing that the market is going higher or lower, assuming that the market goes on further, right? So I think that makes a lot of sense until the market reaches specific target points, only highs or lows that have not yet been reached yet. Very important. And once the market is touching them, very often you will see how the market is wiggling around there for 30 minutes or up to 5 hours very often. And if there's enough pressure, it will wiggle around and then push in that in the further direction, the same direction where it used to go for the past hours. And that will be then very nice. And you can see this only if you take a picture in the beginning, then you take a picture in the end, and then you compare that. So a very big money-making activity, by the way, by taking trading signals, is that you understand the money management into it. That means there are trading signals out there. Well, you maybe need to trade like 4 or 5 hours at one time. Maybe it's like using like 3 charts or something and 3 markets. But in this case here, what I'm showing you over this channel is always the 1 minute chart. So what I like with a good trading signal is that we can just select somewhere freely between 9 a.m. and 4 p.m. Central Time, 1 hour or 2.5 maximum. And then we just trade, use only a 1 minute chart that is almost empty. It just has like 2 indicators. It's an Anchor VWAP and it's a 1 day VWAP. That's already it, and just usual candles, nothing special about it. And then we just zoom out and we can see 1 or 2 days or 3 days on it. And the awesome thing about this is, the first one is in this time, you will see that if you just buy or sell in the future market, that means like future state trading, that you either make or lose $200 or $2,000 within just 1 hour. What is insane, right? It's insane risky. So for that, there's something that is called a stop loss. And the stop loss is one of the most important things when it comes to money management, placing it, of course, where it makes a lot of sense. And those are very, very smaller structured lows or highs, because when the market is trending, it does higher lows. And if the market is trending like down, for example, it is doing lower highs. And only concentrating on the one side and not the opposite is something what can help the trader a lot. Because if the market is doing higher lows and you can see that in smaller structure and you place your stop there, it doesn't matter if the market is doing one lower high or something. If the higher lows are consistent, the stop loss can be placed more higher, the entries can be placed more higher. And if you see then that the market is really pushing up like to a specific reference, then it makes more sense with the money management, because you have your entry, you have your stop loss, and then how much money from entry to stop loss it is, we call it ticks, what is the length, and then you can calculate it with your position size, how much money you want to lose there. And if you do this right and you have a good trading strategy, then it's about like we can put in like $10, $30, $100, we can increase by $10 steps, almost 10 to $20 steps was pretty cool. And then we can get for each trade 5 times or 7 times, sometimes it's 4 or 3 times the amount out in average. And how that works is that we limit, like just imagine a green candle means that the market was going higher, a red candle that the market was going lower. Imagine you have a day right now, if you have a bit market experience, you would have seen that already live, where the market is doing 7 or 15 green candles in a row. Imagine if you see that the market is doing 4 green candles in a row and you see it's going up already for like an hour or 2, because it's a good trending market, as I just explained, the S&P 500 futures using the 1 minute chart. And you see the average candle is this small. And on this small green candle, if you enter the trade, there's a countdown timer. It says like exactly from 60 seconds to 0 when this candle is closing. When you enter the trade, when the green candle closes, and you put your stop loss exactly under this green candle, not below this green candle. Very important, like two below. Like you put it exactly under, like on the ground of the green candle. If you put your positioning sizing now, calculated that you would lose $10 or $100, if the market would do 5 other candles or 1 candles, and in general, it doesn't matter actually how many candles it is, it's just like 1 or 5 candles, and it's just like 5 times longer than this green candle, and you were buying, right? So you used your money management, adjusted it to this green candle, you adjusted, for example, like $100, and that will be then a $500 opportunity trade. And this is something what is very important for a good trading strategy, is that when you just compare it to a 1 minute chart, you have in every area using a 1 minute chart just a green or red candle in any area. So it is important that your trading strategy, I think, is not limiting you by the personality of the market, because it is about where the market is at right now. Because when you see that the market is trending for hours and you can see it's very pushy here in this area and the market is not consolidating, we want to get there in because you can see how the market is pushing in one direction. So the trading strategy is not allowed to limit yourself by, from my opinion, like that you can see like a pattern, like 20 candles in one area or 10 candles in one area. The trading setup must be simple, because it's all about reading the market. And when we see that the market is pushing in one direction until a specific area with experience, by taking a picture in the beginning and in the end, what I just explained, then it's all about like, okay, how can I now adjust here $100 to make $500? And I think the most realistic thing is always using a 1 minute chart. There are other type of charts, they're called range charts or volume-based charts. But these are a bit more complicated. And the 1 minute chart is very beginner friendly. It is very universal. That means like also people who are moving the market, for example. I think like it makes more sense when it comes to the 1 minute chart. If you see a green and a red candle, because the whole world can see it, then using a chart, what you just see, because there's a very advanced calculation in it. And then you just see like green candles, for example, right? But actually in between there was like red candles, for example, for other people who are using the 1 minute chart. So the thing is now following thing with the money making activity. If you trade for 1 hour and you do this within 5 weeks, like 2 times a week, then it's all about how many signals did you you see first afterwards. So what people do is they back test. I don't like back testing because back testing is not in my trading capabilities. So instead of, because like, who knows what happens when I'm sleeping or like when I'm not trading right now. So what is more important is, does it fit to my current lifestyle? So I'm sitting down on the computer, I'm looking at the market for an hour, I'm starting to make a picture, I take some notes, compare to the past 1 hour, what length did the market do, and then I take a second picture after the 1 hour and I compare, did it make sense? And very important is that to take the pictures only in a view of a 1 minute chart while seeing 1 or 2 days. And then once I can see that there are days where it makes more sense that I can see where the market is going at, and days where I can't see where it's going at. And it's also about like 1, 2, or 3 weeks, right? Because the market will have 1 or 2 weeks that the market is more staying in one price, and we'll have 1 or 2 weeks where the market is more rushing to one price. Once I understand this, it's all about not seeing those signals live. It's about being on that time on the computer. And then after I took the second picture and saw what the market did, I'm going to review my signals. Like, did I saw there anywhere the setup where I can adjust $100 to make $500? What is also transferable to adjust $1,000 to make $5,000? What is really, really cool for the money management. So here's just something what is very, very important with this one. That is to write down the signals and the time you traded. There's back testing and there's forward testing. And I believe in so much in forward testing, because if you're a business owner or you have any other work right now to do, then it's all about when can you sit down on the computer to the US session, for example, for 1 or 2 hours. And in your trading time that you write down like, okay, today I sat down for 1 hour. How many trading signals did you saw? And then what money advantages did this trading signal had? Like when putting in $10 or $100, how much money opportunity? Like, was it like $300, $500, or was it just like some weird trading strategy just with $100 opportunity, but you had like 300 of them within 1 hour, for example, right? Like, that doesn't make too much sense, because money management needs to be also done. What is very important for a beginner, what I think, is that placing like 3 to 5 trades a week. This is something what's very important. A lot of traders that I talk with, beginners, also intermediate, that are trading already since 3 years, 5 years, or up to 15 years, they break accounts within days, not weeks, within days. If it's killing them within weeks, the trading account, then it's mostly that the trading risk reward ratio is very, very low, like just like 1-to-1, for example, right? But I'm talking about these fast trading account killers, and usually they happen because the trader is taking more than 10 trades a week. The trader is doing more than 2 trades a day, for example, right? In average. So what happens is just like, it's like you see that the market is having a good week, and then you just place like 3 trades or something. But then you see like the market is having a bad week, and then you place like 7 trades. Like, that doesn't make any sense. So we need to make sure also to understand like these market rotations with the personality. And then when there's more going on, we can place like 5 to 7 trades. If there's less going on, place maybe just 2 trades, none, or just like 3 to 5 trades in average. That's what I would just want to say. Because if we just, for example, assume this is first a demo account for within like $1,000, $20,000, $50,000, we divide it into like 20, 40 trades. Let's just say we start first like with $100 a trade. It's easier for the calculation. If we just take $1,500 from that just for trading, and we look forward to have like $70 to $120 on average for each trade, then it's also important that we invest the $1,500 within 5 weeks or 4 weeks, and not just blast everything out in just 1 or 2 weeks by placing 15 trades, because each trade calculated by $100 a trade is also risk. So it doesn't matter if it worked out, or if we were entering with $100 a trade with the entry and stop loss, and then we just get out. We just used $100 because there was the possibility for each trade to lose $100. And for this, the stop loss is just so important.